Just like you, I used to think accounting was just advanced suffering. You open the textbook, you see debits and credits, you close the textbook. But then one day, I tried starting a small business, and suddenly, accounting wasn't boring anymore. It was survival. Chapter 1: The Business Idea. Imagine this: you decide to sell custom sneakers. You buy each pair for $500. You sell them for $900. You sell 20 pairs in 1 month. You're feeling unstoppable. Revenue equals $18,000. Cost of goods sold equals $10,000. So you shout, "I made $8,000." Accounting gently taps your shoulder and says, "That's gross profit. Relax." Chapter 2: The Income Statement. Reality Check. The income statement answers one simple question: did you actually make a profit? Formula time. Revenue minus cost of goods sold equals gross profit. But wait, you still have rent equals $3,000, marketing equals $1,500, electricity equals $800, Wi-Fi equals $600, transport equals $700. Total expenses equals $6,600. Now, net profit equals revenue minus total expenses. $18,000 minus $10,000 plus $6,600 equals $1,400. You thought you made $8,000, you actually made $1,400. Accounting just humbled you. Chapter 3: The Balance Sheet. The Financial Selfie. The balance sheet shows your financial position at one point in time, and here comes the golden rule of accounting. Assets equals liabilities plus equity. This equation must always balance. Assets, aka what you own: cash, inventory, equipment, furniture. Liabilities, aka what you owe: loans, accounts payable, unpaid bills. Equity, owner's claim: what's left after debts. For example, assets equals $50,000, liabilities equals $30,000, equity equals $20,000. If the equation doesn't balance, somewhere someone miscalculated, or fraud is warming up. Chapter 4: Debits and Credits, the twins that confuse everyone. Everyone fears this part: debits and credits. Here's the cheat sheet. Debits increase assets, expenses. Credits increase liabilities, revenue, equity. And yes, debit doesn't mean minus. Credit doesn't mean plus. Accounting woke up one day and chose complexity. But once you remember dealer, D for dividends, E for expenses, A for assets, increase with debits. Everything else increases with credits. Boom, you just leveled up. Chapter 5: Cash Flow, because profit isn't cash. Here's where students get shocked. You can be profitable and still broke. How? If customers haven't paid you yet. That's why we have the cash flow statement. It tracks operating activities, investing activities, financing activities. Because cash is king. Profit is nice, cash pays the bills. Chapter 6: Depreciation, when your stuff gets old. You buy equipment for $20,000. It won't last forever. Instead of recording $20,000 expense immediately, you spread it over, say, 5 years. That's depreciation. If straight line method, $20,000 divided by 5 equals $4,000 per year. Because even machines age, just like your phone battery. Chapter 7: Ratios, Business Health Check. Ratios tell you if your business is healthy. Current ratio: current assets divided by current liabilities. Above 1 is good. Below 1 is stress loading. Gross profit margin: gross profit divided by revenue times 100. Tells you how efficient you are. Numbers don't lie, they just expose you. Chapter 8: Accounting Principles, the Rules. There are core principles. Consistency, don't switch methods randomly. Prudence, don't overestimate income. Matching principle, match expenses to revenue earned. Going concern, assume the business continues operating. Basically, be realistic, be structured, don't lie. Final realization. That's when I understood. Accounting isn't about numbers. It's about knowing if you're winning, knowing if you're surviving, knowing if you're about to collapse. Without accounting, businesses guess, investors panic, governments can't tax. With accounting, you don't just run a business, you control it. Lastly, if this made accounting less scary and more powerful, you're already ahead of most students. Subscribe if you want more subjects explained without the textbook trauma. And remember, assets equals liabilities plus equity. Tattoo it on your brain.